If you're self-employed and you've been told you don't qualify for a mortgage, this video is going to make you change the way you think about that. Because in most cases, the problem isn't your income. The problem is how the system tries to measure it. Here's what I mean. When you apply for a traditional mortgage, the lender looks at your tax returns, specifically your adjusted gross income. And if you're a business owner, you already know the issue. Your accountant helps you write off everything that you legally can. And that's just smart tax planning. But it also means your tax return might show significantly less income than what actually flows through your business. So you walk into a bank making strong money, healthy deposits every single month, and the underwriter looks at your tax return and says, you don't qualify. That's not a reflection of your financial strength. It's a limitation of that particular loan program. This is where bank statement loans come in. A bank statement loan is a type of mortgage that falls underneath the non-QM category. That stands for non-qualified mortgage. And before that sounds like a red flag, let me explain what it actually means. A qualified mortgage follows a specific set of guidelines created by the Consumer Financial Protection Bureaus. Those rules work really well for W-2 employees with steady paychecks and simple tax returns, but they were never designed to capture how self-employed people earn money. A non-QM loan simply uses different documentation to verify income. In this case, instead of tax returns and W-2s, the lender reviews 12 to 24 months of your personal bank statements. They total your eligible deposits over that period, and they divide the number of months to get an average monthly income. That number is what you qualify on. For business accounts, the lender applies an expense ratio, typically around 50%, to account for operating cost. So if your business deposits average, let's just say $20,000 a month, the lender may count $10,000 as qualifying income. But some lenders will accept a CPA letter documenting a lower actual expense ratio, which can increase your qualifying income even further. For personal bank statements, lenders may count up to 100% of the deposit, since the assumption is that the business expenses have already been accounted for before the money hits your personal account. Now, who's this actually for? If you're a freelancer, independent contractor, small business owner, consultant, or gig worker, and your tax returns understate your real earning power because of legitimate deductions, this program was built for your situation. Most lenders require at least 2 years of self-employed history. Some will consider a year if you were previously in the same line of work as a W-2 employee. You'll also need a reasonable credit score. Requirements are going to vary lender to lender, but the general range starts in the low to mid 600s. And yes, the down payment and interest rate requirements tend to be higher than you would see on a conventional loan. That's the trade-off for the flexibility in how the income is documented. But the real question becomes this. If the alternative is no loan at all, is a slightly higher rate actually a disadvantage? Or is it the cost of getting into a home and building equity now instead of waiting for a system that was never built for you to suddenly start working in your favor? This is also where a lot of people get stuck. They hear that the rate might be a little bit higher and they stop there. But consider this. You can purchase a home today using a bank statement loan and then refinance into a conventional loan down the road once your tax returns reflect higher income. Many borrowers use this as a bridge. You get in the door now, start building equity, and you reposition later when the numbers on paper catch up to reality. Let me walk you through what the process generally looks like. You provide 12 to 24 months of bank statements. The lender calculates your income based on the deposits. They review your income, your assets, your debt to income ratio, and your reserves. If everything lines up, you get approved. Most bank statement loans close in about 21 to 30 days when the file is clean and complete. It is not a complicated process. It just requires a lender who understands how self-employed finances actually work. And that's the key. Not every lender offers this product, and not every loan officer knows how to structure these files properly. So the person guiding you through these matters. If you're self-employed, you've been told no by a bank, or you've been sitting on the sidelines waiting for your tax situation to change, I would encourage you to explore whether a bank statement loan is the right fit for you. I've linked our calendar below so you can schedule a quick call. No pressure, no commitment, just a conversation about your specific situation and what options are actually available to you. And if this was helpful, subscribe down below so you don't miss the next video. We'll see you soon.